From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first Friday in May, 2025. Let's check the calendar. Your Milwaukee Brewers are home this weekend with those Chicago Cubs, followed by the Houston Astros. Did I mention the Cubs were in town this weekend? And your Milwaukee Bucks go on summer vacation a little earlier than expected, losing to the Pacers 4-1. There's a bunch of Cinco de Mayo parties this weekend, including one at the Zocalo Food Truck Park on South 6th Street. Take your choice of food trucks, all in a row. Also, the first Saturday in May means lots of hats and mint juleps. It is the 151st running of the Kentucky Derby. All right, first up. A Metro Atlanta Police Department is under scrutiny after arresting a man for a violent home invasion. Why? Well, the victim claims the attacker kicked in her door and then fled on foot. Here's the problem. The accused man is paralyzed and has been wheelchair-bound for over 20 years.
Ooh.
Thankfully, all charges have now been dropped. In Japan, a man had to be rescued from Mount Fuji twice in 1 week. Now, I think most of us would be done after being airlifted off the mountain the first time, but this young man went back up just days later. You're probably asking yourself, what was he thinking?
What was he thinking?
He just needed to retrieve his cell phone. Finally, Alabama's probably one of the last places you'd expect to see a kangaroo hopping down the interstate, but that's just what happened recently in Macon County. Local law enforcement and the owner were able to wrangle the misplaced marsupial back home, where she's reportedly doing just fine. At the big table today, we've got Art Rothschild, John Sandstrom, Joel Driesing, and with a look back at the week, here's Kyle Tetting.
Well, thanks, Jason. A bit easier to laugh this week again. The NASDAQ up 3.4%, closing 17,978 at the bell, up 595 points this week. The S&P added 161. That's up 2.9% to close 5687. And the Dow Jones Industrial Average also up 3%, closing at 41,317 after adding 564 points on Friday. That's 1,204 for the week. A very, very strong week overall. The S&P putting a cap on now 9 consecutive up days. You know, Art, it feels very much like we have been in rally mode now for a bit of time, and yet a lot of that came amidst what we otherwise would have thought was a period of pretty meaningful uncertainty. You know, we kind of started April, you mentioned in kind of your pre-show notes that you were on a month ago, right as we started down that path of uncertainty. And I think a month ago we had a very different expectation for where this was headed than where we are now.
Yeah, this was you might agree with this. I think it's the craziest month I've ever seen. When you look at the volatility a month ago caused by Liberation Day, you know, it's tariff policies that didn't make sense to most economists, which caused consternation on the part of investors, which caused them to sell, followed by some pretty slick moves on the part of the Trump administration to dial back the pressure that was being put on the market by these tariffs. That hasn't really changed. We're still going to have uncertainty. So that was the storm. The calm then came. So this is not the calm before the storm. We had the storm first. You wrote a great article that it would suggest people read. It's going to be in our latest newsletter, talking about storms. And you shouldn't get out there and fix your roof, you know, because it could get worse. And I think that's true. But it's a great time to take stock in how your place is built in the first place. And so when we're looking at performance as we are every day, I think it's a miracle, as you just alluded to, how well our clients have done because we balance portfolios. We don't put all our money in the stock market. We put money in bonds. We put money in cash. And then style diversification, which we talk about all the time. The growth stocks have been, for the most part, the most volatile. So they went down the most. They've come back the most. But the things that have really been steadily either above water or just sinking slightly and then moving higher are these value stocks. And as you've mentioned repeatedly, international stocks. So this has been a great month. It was a great week. I forget if it was 9 days in a row or something like that. We've had the markets moving higher. So as an investment advisor, I'm absolutely thrilled with what we do and how our clients are sitting pretty in here. But as you suggest, this is a great time to take stock of where you are if you want to be doing something different, especially, if you were scared out of your socks when the tornado first blew through.
I think there's this tendency to think that, well, everything's fine. We're back to normal. Stock markets have, not fully recaptured the start of the year numbers, but, the S&P now down just 3.1, the Dow down 2.7. We've clawed quite a far way back, and I think there's this tendency to go, well, everything's fine, right? That, we get periods of volatility, and our portfolio did great. Bonds were up, the value stocks held up just fine, and maybe our growth stocks sold off a little bit, but when I look at my portfolio, it's flat, slightly positive, slightly down, depending on the mix, but it's around that number. And I think there is then this tendency to think, well, that means everything's going to be fine going forward. But I think we have to look back at the last month and go, first and foremost, what kind of pain did it cause us? What kind of consternation as investors did we have? Because that tells me what's going to happen maybe in 75 days if this pause is not the thing that ultimately leads to resolution. But what happens the next time this falls? And John, I know one of the things you and I have talked a lot about recently is kind of the shape of recoveries, right? And right now we've seen this kind of down and up, kind of looking like the letter V, but they don't all go that way. And I think there is this potential hanging out there now that maybe we see a little more volatility ahead we need to be prepared for.
Yeah, and we actually talked about this earlier today, is potential for a W shape. And I think that's definitely a possibility. You look at the last 2 weeks of recovery or so, I think you said 9 days, and that's all good and great, but we still kind of have this hanging thing out there of this 90-day pause. And we've kind of found ourselves in the middle, like you said, where it's a little bit calmer after the storm, as Art said. And it's given people a reason to maybe, hey, we weathered a good portion of the chaos at the beginning of the month, and people are slowly buying their way back in. But, if we don't see any type of, pullback on the tariff conversation or deals being done, that uncertainty is still going to be there for that 90-day pause. If we get closer and closer to that date and none of that uncertainty has kind of come to light, we very well could be looking at the down portion of the W. And then we talked about, a lot of economists discussing the term recession at the beginning of April. And obviously that's something that looks pretty legitimate after the first couple weeks of April, and we've already started to see a comeback on that. But the median drop for recessions over I forget what that number was, the research.
Going back
80
decades
years or
Yep.
something like that. From the peak to the trough at the beginning of a recession is a median 20%. And we did about 19% in 3.5 weeks. So there is part of the conversation that says we could have already felt part of this recession.
Yeah, and I think important to remember that stock markets are a forward-looking indicator of the economy. And so if what we're talking about is the possibility of recession, well, Joel, we had some information on GDP this week, which I think caught a lot of people off guard. A lot of nuance in that. Certainly a lot of the kind of precursor to tariffs maybe caused some of what was a first quarter in decline. But again, I think the surprise was a little bigger than what many were expecting.
And that's backward looking. So it's looking at the first 3 months of the year, and the data isn't all there yet. They're going to revise it 2 more times before they come out with the final number. But it declined for the first time in 3 years, went down at an annual rate of 0.3%. And that's after going up 2.4% rate in the previous quarter. And a lot of it was what I'm seeing referred to as pull-throughs. People were buying imported goods a lot more in those first 3 months, anticipating Liberation Day and some sort of announcement that there was going to be salvo fired in the beginning of a trade war, and they wanted to sort of take advantage of where prices were now and avoid higher prices later.
Yeah, if I could, the stock market as a leading indicator isn't always right. And so back in 22, we did have a bear market, meaning the stock market sold off more than 20% because the Federal Reserve was raising interest rates and the market anticipated a recession. We did not have a recession the next 2 years, driven by growth stocks that sold off the most. We did 25% per year on the S&P. Compressing that to this month, I mean, this is unbelievable. The stock market anticipated a recession when it sold off so dramatically, earlier this month. By the end of the month, it's not anticipating. It's less anticipating that. Back to your 90 days. I think what we're witnessing, whether or not we think tariffs are a good thing, we're witnessing an administration that wants to make change and is testing the limits of how it can make those changes. We don't even know where they're going. I'm not sure they know where they're going, but they're learning how what they're doing is affecting the markets. And so hopefully they'll pull us back from the brink again the next time they cause us to almost go over the edge, within the next 30 days. So the Trump put, as it's been referred to, perhaps is back. I think he's learning how to adjust it. We'll see. And I'm not saying I endorse any tariff policies. I don't like tariffs at all. But the underlying economy is so strong that it's been able to withstand this medicine of a change, caused by tariffs, or the tariffs themselves are a change, whether or not it changes anything else. So I'm cautiously optimistic based upon what happened this month. Now, that doesn't mean I can predict, but it does mean that we should still take stock of what we have, and we don't want to overdo what we have in the market. But these backward-looking numbers, as you point out, really aren't telling us anything.
And they're not always right.
Right.
Because in 2022, the same time you're talking about, this same GDP number, looking backward, showed us 2 quarters in a row of recession, of contraction in the GDP, which is sort of the shorthand way of saying that we're in a recession, but we weren't in a recession.
Well, and I want to be clear that I think there are a couple of moving pieces here. The first is that, when we talk about how we construct portfolios around this, we need information in order to motivate change. And we have an absence of information right now, a lot of speculation, a lot of uncertainty, a lot of things that need to be resolved. But if we are talking about what should we be doing differently with our investments, well, we need some clarity on where this is headed. Until then, I'm content to know that balance is going to help us weather just about anything. And yeah, maybe there's some tweaks here and there depending on need, but for the most part, if it got you this far, it's probably going to keep you going. The bigger problem I see is that we are so used to relying on these tools that for the last 30, 40, 50 years worked really well, whether it's rules of thumb on what a recession is, whether it's the Fed cutting rates or raising rates to, stymie or to stimulate growth. And I think the reality is we're moving into an environment in which many of those historical tools aren't as effective. I look at 2022 and whether or not we ever actually hit recession is the perfect example. Yeah, we never officially declared it, a reminder that we're not in a recession until the National Bureau of Economic Research says we're in a recession. There are those rules of thumb, but we saw mass layoffs in the technology sector. We saw manufacturing slowdowns. The problem is they just didn't come at the same time the way a recession normally does. And so I think in many ways, those typical tools just aren't as useful when the economy moves as quickly as it does now. And that was true 2 years ago. I think it's even more true now. And so we have to look at the data. We have to kind of go back and go, what has happened? But at the same time, we are very much operating in a world where things are changing much more quickly.
And those academic economists who are in the National Bureau of Economic Research, the last couple of times that they've ruled on whether a recession was underway and when it had ended, they were pointing out that they were looking very closely at labor numbers and job growth numbers. And we had a report today that surprised a lot of people because, amidst all of the boost in imports and people buying cars quicker than they were expected, we've got employers hiring more people than expected.
Yeah, and I think at the end of the day, you can look at the unemployment rate, the participation rate, you can look at kind of all those pieces of the labor market and go, well, are more or less people working? Are there more or less people looking? But what matters is are the people spending, right? Are we seeing it come through in consumption? And even signs there that things were, especially in the first quarter, maybe a little better than we thought. We had spending on the consumer level boost the GDP number a little bit, even as those imports were dragging it down. And so when you kind of do the math and go, how is the economy? Well, probably weaker than we thought, but stronger than maybe what you'd otherwise be pointing towards as concerning. I don't know that that's a good answer. Because I think the reality is that's where we've been for a while, that it was a little weaker than we could have hoped, but stronger than what would be otherwise concerning. But at the same time, it is very much driving in the rearview mirror. And as investors, we're always looking for what comes next. Not a lot of data, usually in the economic indicators, that gives us that. The one that we do point to sometimes is the consumer sentiment, the consumer confidence numbers. We got consumer confidence this week, and again, not terribly great, especially when we look at kind of current conditions.
Right, and there's an instance where consumers aren't feeling good about the job market, and yet we had numbers today that clearly show that the job hiring and employment market are better than we had expected. That was for the month of April. So that's actually in closer time to when those consumer confidence, consumer sentiment numbers come out.
And then, I think we look at the economic indicators being kind of the overwhelming piece of the story this week in terms of just volume of data. We got confidence, we got GDP numbers, but then we got some information on housing and construction spending, manufacturing, all the pieces that are a little more physical, right? Things we can touch, things we can hold, and a lot of mixed news there as well.
Then again, the National Association of Realtors said that one reason that there's still demand for housing at a time of uncertainty, at a time when mortgage rates are higher than they have been for a while, at a time when prices keep shooting up, the reason that there's still demand is because of job growth. They look at the hard numbers, not the consumer sentiment numbers, to say there's still job growth, and as long as that happens, there's going to be demand for housing.
And ultimately, when there's demand for housing, there's demand for consumption when you look to fill those houses. And so I think it's one of the kind of backstops to, if the economy does continue to slow, how far does it go? Well, the labor market's really going to tell the story there, just like I think it ultimately leads then to spending and other things. As I think we have pointed out repeatedly over the last few weeks, a lot of questions still to be answered there. We'll have a Fed meeting next week, which I think gives us some more on kind of how the Fed views the world. But John, I know one of the questions you get a lot is looking at your portfolio and trying to understand, or clients looking at their portfolio when they're talking to you and trying to understand, why am I down from that place where I was? Why does the portfolio look so much worse than what it looked like, just a month and a half, 2 months ago? And some of that maybe comes back to framing, right? That, I can pick a time period, or I can pick an indicator, or I can pick a number. Depending on what I choose to compare it to, I can tell a very different story, right?
Yeah, and everything is relative, right? So if you look towards the end of last year, a lot of us were having conversations with clients talking about how the stock market was stretched. Stuff was overvalued, which means that stuff that you own in your portfolio is most likely overvalued at that time. Meaning, if you're high watermarking or looking at the high point of your portfolio, that might not mean that that's what it was actually worth at the time. So you have to be, a little bit more flexible in looking at how your stuff performs over time. And ultimately, as we talk about all the time, it's time in the market, not timing the market. And I think that this last 6 to 8 weeks is a perfect example of why we do what we do.
And so perhaps we got to those high water marks faster than we might otherwise have gotten there. but I don't think it necessarily means we're not supposed to be there eventually, right? That I think investor portfolios, maybe looking at your year end or your mid-February numbers looked a little better than they look today. It doesn't mean we can't get back there. And most importantly, I think if you've got a long enough lens, you can kind of see the path to how we get there.
Yeah, the favorite part of my reviews is going back in time. For clients who've been around here decades, like, wow, look, you've done 6-7% per year over X period of time. Those are wonderful, revelations to the clients who may have made the mistake, as John suggested, and as you were alluding to, of looking at the high water mark. What a mistake. I had a client a week ago send me a note concerned about, gee, he's down X amount from where we were when we peaked this year. Well, that's the mistake. The more money you have in the game, the more the market goes down, the more you're going to lose. You're going to get afraid of heights. So if you want to be able to climb as you should gradually over time, don't do that. Just understand what you have, why you have what you have, and be confident that over time, and this month proves that, no matter what's happening, no matter what the winds of change may bring, that if you're invested in the stock market, you're probably going to make money over long periods of time. But you have to weather as your article points out, you have to weather the storms. So forget about those high water marks. We'll get back there, but it's the ride that really counts.
We've got a wonderful newsletter coming out this afternoon. A really good article from our colleague Steve Giles talking about withdrawals during periods of uncertainty, and such an important concept, I think, to understand that just because things are down or just because you feel some unease about the way the market is headed or the economy is headed, it doesn't mean you didn't plan long ago for what you would do in those situations to be able to maintain lifestyle, to be able to continue to take money from your portfolio, to be able to navigate that uncertainty. We talk about the role of balance, but I think it's even bigger than that when we talk about withdrawals. And so the article from Steve, some good content from Joel, as always, on navigating Social Security, and some, I think, continued warnings on just being safe online. And then, you point out my article, and in many ways, I feel like we are sitting in the eye of the hurricane, and it doesn't mean that what comes next is necessarily going to be as, I think, devastating or unnerving as the first half of the storm was, kind of navigating April. But it does mean that we need to be a little bit more cautious about how we are preparing ourselves for what comes next. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.